Hong Kong has placed itself at the heart of what could be one of the world's most important financial developments this century, the internationalization of the renminbi. From trade finance to dim sum bonds and investment funds, opportunities to use the Chinese currency are growing. Hong Kongers have long been able to withdraw renminbi from ATMs, even though it's not exactly a parallel currency alongside the Hong Kong dollar.
The broader internationalization of China's currency will take an important step forward on November 30th if, as expected, the International Monetary Fund agrees to add the renminbi to the select group of currencies backing its special drawing rights. Now, inclusion in the SDR basket may mean little to the man on the street, but it is significant. Here are the FT's 5 key points to understand why.
Special drawing rights are a unit of account used by members of the IMF, that is, governments.
Essentially, the SDR is a synthetic reserve currency, currently backed by the 4 biggest, the dollar, the euro, the yen and sterling. Joining this exclusive club is symbolic, a sign that China has made it, and that the international community has confidence in the renminbi.
There might be a bit of euphoria that the renminbi has finally crossed the finishing line, that it's actually been included, but I think that that type of euphoria would be very, very temporary. From a longer-term perspective, it'll probably mean that actually this currency is getting a sound backing to actually be considered a reserve currency. But that's a very, very long-term story. You know, we're talking multi-year process here.
So, will being an SDR currency tempt the managers of the world's central bank reserves to increase their holdings of renminbi assets? Right now, about 2/3 of the world's reserves are held in dollars. But within a decade, reserve managers expect to have perhaps 10% of their holdings in renminbi, according to a survey by HSBC. The question is, what do they buy? Bonds are generally seen as a more reliable investment than equities. Those issued by highly rated governments like the US or China are considered safer, more liquid and more predictable than almost any other asset class.
The market has grown rapidly over the past decade. It is actually growing from 0 to one of the biggest in the world right now, but it is still small in terms of the size of the economy. For example, the bond outstanding to GDP ratio is about 50% only. And that is pretty small compared to international standard, especially to the size of the developed countries, which is about 200% on average. Okay, and in addition to size, I would say the next issue would be the structure of the bond market. Right now, China's bond market is dominated by government bonds, which account for over 2/3 of the bond outstanding, and most of them are central government bonds.
Having embedded the idea of open markets to get itself included in the SDR, the hope is that China will continue to reform. The liberalization of renminbi trading over the past 10 years is an example of China's general approach. So far, the path to a slightly more loosely managed currency has happened in a series of steps that have usually caught the markets by surprise. In other words, investors know roughly where China wants to go, but have very little idea how or when it will get there.
Being ranked alongside the dollar, the euro, the yen and sterling is certainly a sign of acceptance, but it doesn't make the renminbi a true global reserve currency just yet. To put it in context, there aren't currently enough renminbi outside the mainland for Hong Kong to be able to consider switching its dollar peg, a very long-standing peg, for a link closer to home. So SDR inclusion is a step along the road, but there are many more to come. Jennifer Hughes, Financial Times, Hong Kong.